My guest today is Rob Johnson, the Chief Actuary at Beach. Rob started his P&C career at QBE in Australia, eventually holding various analytical and management positions in both insurance and reinsurance firms before joining Beach as a consultant in 2004. Rob has been a mentor to me since he's been at Beach, and I'm not sure I would have become an actuary if we hadn't crossed paths. Maybe we'll get into that today, but this is about Rob. Rob, welcome to the show.
Thank you.
So, in talking a bit about your bio, we're preparing for this, you said that your first boss at QBE was an actuary and an underwriter. So who was he and how did he influence your career path?
The name was John Trowbridge. He had previously been in the government actuary's office, which was quite sophisticated in Australia. And when I applied for the job, he was just the actuary. But by the time I actually joined, he'd been made manager of head office underwriting.
So QBE then was a much smaller company than it is now.
QBE was a much smaller company. I recall doing the workers' comp outstandings for Australia in those days, which was $30 million of outstandings, which is obviously nothing.
Wow.
In those days, most of its business was Australian business. It had offshore business, but that was quite small. It's obviously now mainly non-Australian business.
What does QBE stand for? You
QBE,
know this, don't you?
I do, yeah. QBE is a merger of three companies. The first one was Queensland Insurance. The second one was Bankers and Traders, I think. And the third one was Equitable Life. And the reason that it actually was brought in is that the general manager of QBE had come from the life side, from Equitable Life, and therefore was sort of happy to have an actuary involved.
Which is what you were at the time, too.
Yes.
But actually you're referring to was your boss.
That's
Steve.
right, yeah.
So he came on as an actuary, which was uncommon at the time to have an actuary?
It wasn't uncommon to have an actuary, although in those days there might have been about 4 or 5 in Australia who were working for general insurance companies. It was a very small group. You could literally name them on sort of 2 hands.
They're all life actuaries then, all the actuaries.
Yeah, when I was at university, everyone did life insurance. It wasn't even contemplated that you'd do general insurance. One of my colleagues was on a scholarship with what was then called NRMA, which is now IAG, which is a very large Australian insurer. And we were all quite puzzled as to what the hell he was going to do when he went to work for NRMA because they did car insurance. It was very confusing.
And so this boss of yours, Steve, right?
No, John Trowbridge.
John. So John, he went from actuarial breaking ground there in general insurance and then moved into underwriting as well. He did.
As manager of head office underwriting, to be fair. So the way it was set up was the underwriters were out in the regions. The head office underwriters were what I would now call portfolio managers. Their job was to set the underwriting rules, to set the pricing, to make sure the systems worked, to do audits. They would sometimes underwrite the more complex risks, and he was their manager. So he was managing the underwriting function rather than being, if you like, a Lloyd's underwriter sitting there making individual deals.
Is there an analog or an equivalent in an insurance organization today? I feel like you're either an underwriter or you're an actuary, and it seems like this role is a bit of a hybrid. Is that right?
I'm inclined to agree. We're interviewing some people now, and it does seem clear that most actuaries do pricing, reserving, or capital modelling, and very few seem to have any experience as an underwriter or running a business or running a portfolio. In my view, that's a shame, that's a mistake. I think the real skill comes from actually running part of the business. It's easy to advise. It's much harder when you've got to make the complex trade-offs between writing business and making profits.
So at the dawn of the actuarial era for insurance, there wasn't really an understanding for what actuaries were going to do, and so there became these underwriting manager group. Is that kind of a right way of thinking about it?
I think it'd be fair to say there wasn't an understanding. A lot of actuaries then and still mainly did outstanding claims. But in those days, a lot of it, the industry at that stage, at least in Australia, had come off what was called a tariff. So there was an industry set of prices and covers. Everyone offered those. It was all very standardised. So most of the management had grown up in an era when they didn't have to think about pricing or underwriting. There was a set standard for the industry. That was obviously knocked down with legislation about anti-competitive behaviour, and they all had to then set their own prices and whatever, and they were simply not equipped to do that.
So pricing actuaries literally didn't exist.
That's right. Oh yeah, I think 2 years before I got in it, there were none.
None, and so John, career path did foreshadow your own, right? So you spent time in the actuarial department, and then moved into an underwriting management role or portfolio management role. How long before that happened? How long were you an actuary under John at QBE?
He actually was only there for about 2 years and moved on to to set up a consulting firm, which is now under various different names, the largest actuarial consulting firm in general insurance, possibly in all fields, in Australia. I then worked for Frank O'Halloran, who's a fairly famous name. He was head of QBE up until 2 years ago. So I was in the head office underwriting area as an advisor, as an assistant to the head office underwriters. Any analytical work, pricing systems, underwriting reviews, reinsurance. We did a lot of more just on putting the submissions together. And I was there for about 5 years. And then after that, I actually went and worked in reinsurance for a company called American Re as a fire facultative underwriter, which is about as far as from actuarial as you can get. I was only there.
Why that move?
Basically to commit to insurance and to underwriting, I think. At that stage, I'd started doing the Insurance Institute exams in Australia. And so it was sort of a commitment to being not just the backroom actuary, but to being involved in the underwriting and management. I was only there for 3 months. It would be fair to say that the management at American Re had a very old style of management, and that didn't quite gel with me. But after that, I joined a company called Phoenix Prudential, which eventually rolled into Royal and Sun Alliance, and then in Australia into Suncorp. And I was the assistant manager in the head office personal lines division, and I specifically ran the car insurance portfolio, which had the enormous premium income of $6 million per annum.
I can't help but think about how that is. So you made the decision to go out of actuarial into underwriting because you wanted to be closer to the business.
That's right.
A very common thing for me to hear about actuaries wanting to do. And in my own career, I went from being a trainee broker to an actuary to get closer to the business. And the logic there being understanding how it works, what goes on under the hood, what are we really producing, what are we really selling. And maybe that's a commentary on the different cultures of the organizations, ours versus, say, QBE or Royal Sun Alliance at the time than anything else.
It was an evolving area. Obviously, actuaries had only just become involved. I'd say that, in particular, Phoenix Prudential, which is the company that I went to, the number one and number two guys there were Ross Hensman was number two, and John Malik was number one. Both of whom were amazingly good managers. And they sought me out. They basically realised that they, particularly for car insurance, which is perhaps the most statistical of classes, rather than say deep end casualty or property or whatever it was, they realised that it was a statistics game. They needed someone who actually understood the statistics. They had a number of people who understood cars and if you like understood detail, but didn't really understand portfolio management. So they approached me, which was sort of great for my ego. But
you spent 5 years at QBE in an actuarial role.
Yeah.
And that's when you were taking the exams.
That's right.
So did you stop taking the exams when you moved over first to the facultative underwriting role at American Re, and then
I stopped taking the exams at some time in that 5-year period. I can't quite think when. In those days in Australia, the way it worked was you became an associate essentially after you finished your university degree, which I did. And then you did 4 fellowship exams, all with the Institute of Actuaries in London, all by correspondence, which is obviously a very hard way to do things. Those 4 exams were life insurance, general insurance, pensions and investments, and effectively they expected you to be a practicing expert in the UK environment in those subjects. I like to think I sailed through the general insurance subject, no trouble at all, and I failed dismally at all the others. At this stage I had a young family, and as you probably recognise, studying with a young family is very, very difficult. And it just became clear that it was clear that it was going to be very, very difficult. But the other thing that I realised at the time was that actually not being qualified was an advantage. I think most people who came in as actuaries de facto had to go into senior positions which cost a lot and which were challenging to the existing management. Not that I like sort of costing less, but coming in a slightly more junior position was actually less challenging and meant I actually had a broader remit to sort of develop from there. So I think I don't know that I designed it this way, but the fact that I was less qualified at that time than
Made you
others.
more independent.
Yeah, I was sort of less threatening and I could sort of move more broadly, which ultimately was a good thing.
But around that time, you authored a paper, which I only learned about last week when we were talking, and I read it since. And so what was fascinating me about that, actually, first I'll ask, when did you write that paper? At what point here in this? It must have been around then.
It was presented to a general insurance seminar run by the Institute of Actuaries of Australia in November 1980 at a conference in Broadbeach, which is on the Gold Coast in Australia.
So while you were at QBE,
Yes.
kind of midway through your term there.
In fact, very early on, because at that stage John Trowbridge would still have been at QBE, so it was in the first 2 years.
And did he contribute to the thought process, or?
He encouraged me to do it. It came out of work we were doing on the outstanding claims, but it's all my own, for good or ill, it's all my own work.
So it was fascinating for me to read this paper because I very much think of it as the Rob Johnson paper, actually. Amazing how it manifested so much of how I think of your intellectual style is present in that paper. And what I mean by that, and for one, there's lots of math in that. I've never seen you use math, but that was interesting. But
I have done it.
But evidence in the paper, it's written down, you can see it. But the core insight, I'd say, is something you've been preaching for as long as I've known you, and that's that estimating claims costs really is about how many claims and what do they cost. A very, very simple way of breaking down the insurance business. Now, I think of your, in the paper anyway, you spend a lot of time talking about how different techniques really are expressed in this kind of universal truth. The paper is called a general statement, and this is a generalization of how insurance reserving techniques really work, maybe. And so I kind of see your intellectual contribution, your style as being about a rejecting of needless complexity in insurance. And there are a lot of actuarial textbooks out there, but is it really simpler than it seems?
Yeah, that was interesting, the genesis of the paper. Slightly long story here. Basically, in those days, and still to an extent today, the whole outstanding claims process was just seen as you had a triangle, basically, or a set of data. You put that into some sort of a sausage machine or black box, and the answer popped out the other side. And whilst we could see that answer was, if you like, realistic, that the way it was doing things was sort of correct, if you like, it was still a black box. It was still, you feed some numbers and you get something out. A guy called Tig Melville, who is obviously now passed on, but he was either the president of the Institute of Actuaries and or the government actuary and or the Life Insurance Commission, I can't remember which, but he was heavily involved in general insurance in the early days. He made the point that, looking back at life insurance, which is where we'd all come from, in life insurance, actuaries would have a valuation basis, and that once that basis was stated, the answer was just a matter of calculation. It may have been complex calculation, but just calculation. And that the actuary's job was to apply professional judgment and skill to coming up with that valuation basis, i.e. a clearly enunciated set of assumptions. And that's what he was encouraging people to do, was just come up with a way of describing, to come up with a valuation basis. And so my paper basically said, well, here is what I think is a valuation basis. Very simple, number of claims, average cost of a claim, run-off distribution, inflation and discounting, if you like. And it just made the point that if you looked at all of the black boxes, if you like, at that point in time, they could all be, in essence, expressed in those 4 or 5 basic terms.
Now, you said during the seminar you ran into a senior actuary in the business, and he made a kind of amusing comment to you. What was that?
Yeah, that was Richard Cumpston, I think was his name. He sort of sat me down and he said, this paper is either brilliant or complete rubbish. I said, I think the former, but I'm not sure.
and so I sympathise with this confusion. So let me give you kind of a take on that. So one way of looking at this is insurance is actually incredibly complicated, and this formula is very, very simple, right? And so I think that there's an intuition from people where this there should be more to this. And I think that maybe what's confusing or what's interesting about it is that you use the word generalized, right? Now in a physics paper, generalized would mean let's talk about some underlying function or what's going on underneath, which unifies many other ways of looking, many other examples of this problem, right? In this case, you're actually generalizing on an effect as opposed to a cause, is one way of thinking about this, right? So how many claims, what do they cost, doesn't tell you anything about why those claims cost how much or why there are so many claims. But maybe what's really happening here is that is actually too complicated to figure out. And by trying to do so, you just get distracted and so lose some of the value of describing what's really going on. What do you think?
Yeah, I agree with that. I think with the benefit of 2020 hindsight, the word generalised was the wrong word to pick. The paper essentially was lost to obscurity after 1980.
Except
we'll come back. We'll come back to that.
Okay.
Yeah, it was sort of at the time criticised because it didn't have any stochastic terms in it, which in those days was, my attitude was, we still don't know what the mean is for half the things, or most of the things we're trying to do. Let's not worry about standard deviations. Yeah, it's a descriptive way of describing what's going on. What's interesting, there's a paper brought out at the time, I might have referred to it in my paper, by a guy called Harry Reid, who effectively applied some n-dimensional surface to n-dimensional triangles, I guess. And it was incredibly complicated and whatever. But the key thing is, once you had a look at what he did, all he was saying was that in my terms, the number of claims, average claim size, runoff distribution and inflation components may well have varied by the size of claim. Large claims may have taken longer to run off. They obviously cost more. There'd be a different number of them. So you had this incredibly complicated n-dimensional surface. But in reality, all he was saying was small, medium, large, whatever breakdown of claims you choose will have different characteristics. If it makes sense to break it down to that, you can do that. So I would say it may have been better if I called it a general description of the process.
Yeah, but I think that I still think that there's a lot of intellectual force behind the idea, because by getting stuck into things like your n-dimensional surface, and you referenced that paper in your paper, actually, I think.
Yeah.
You confuse people, you scare people and drive them away from what you're really saying, I think, because you're making it more complicated or making it appear more complicated. Some might say you're making it appear more realistic. I'm not sure, but the key thing I think of actually your contribution is that's distracting you from getting the job done. And the job done is let's figure out what's going on here, or at least what the effect of all this is going to be. So if we stay focused on the effect, then we'll actually get the answer that we can use.
That's right. To me, it was a matter of, I've always taken the view that number of claims and average claim size is the issue. The paper makes a point, and I think it's an important point, is prior to that you had black boxes which define what happened. What I've said is, in essence, I don't care how you go about analysing the data. Analyse the data in whatever way makes sense with the data you've got and the tools you've got to do that. You can go into great complexity if you like, and you should if that's appropriate. But at the end of the day, you can summarise your conclusions down to a number of key numbers, and you can easily communicate those. What was fascinating is at the time there was a lot of work on particularly workers' comp in Australia, which is a long tail class of business. It was running at horrendous loss ratios, and the actuaries were trying to wrestle it under control. And part of the problem was just convincing insurers that they were losing a lot of money. So it was sort of standard in those days, every time you wrote a paper about some new technique, was to apply that technique to a standardised set of data that was available to everybody from the government authorities. And one of the things that I did not in that paper, but separate to that, was to point out that if you looked at everybody's study and worked things out, they're all getting basically the same average claim size, which in those days was around $2,000. And that once you realise they're all getting the same answer, that all made sense. The other thing to say is that whilst I've talked about number of claims and average claim size, you don't have to look at it that way. Those two numbers multiplied together are just total incurred. You can, if you want, talk about premium income and loss ratio. That's total incurred. You could talk about number of vehicles, if you like, and cost per vehicle. That's total incurred. You could talk about total sums insured and a burning cost rate, if you like. That's still total incurred. to me, the most logical way to do it is number of claims and average claim size, but you're not limited to that.
Well, it's nice in that it has a physical representation in the world, which is you have a claim count and you have a claim value, except when you don't, because sometimes it can be really difficult to figure out how many claims you have.
Yeah, sometimes you do, sometimes, and in the work I do now, sometimes we'll use premium income, sometimes we'll use something else. Sometimes you've got nothing, and you just got to say, actually, I'm just going to do with the total incurred number. You do the best you can with the data you've got.
Yeah, and the data you got is almost always going to be a part of the problem that you have to solve. Yeah. So maybe, what do you think about that? How much of the data in the world is dirty?
Oh, all data is dirty. I've got a couple of comments there. All data is dirty. There are always things in there. But I think, particularly for us being one step removed, I think one of my advantages, having actually worked in the insurance side, is you actually got close to the people who were putting policies on the systems, who were paying claims, who were doing endorsements, who were setting up renewals and whatever. And you realise it's a complex process. They're relatively junior people. Their priorities and objectives and pressures aren't the same as what the actuary's priorities and objectives might be. Getting a payment done is what they might want to do in a claim situation. The other things that an actuary might sort of like to have aren't top of mind for them. So you need to realise there's a process there. You've got claimants, you've got people all over the place. You've got, you can have people set up 2 or 3 claims just because it's convenient out of one event, simply because it's convenient to do so. Claims can have multiple components. So anyway, you realise there's dirty data, you realise there's errors, particularly where sort of information's alphanumeric. You can have, things sort of, out by one spot. You can have blanks where there, in one case there's no blanks elsewhere. Now you get lots of dirty data. Having said that, the other comment that I would make is, in all the years I've been doing stuff, I have hardly ever been in a situation where there hasn't been enough data to do something. My comment would be insurance data isn't necessarily as volatile or as difficult to read as people think. That isn't to say that it can't be volatile and difficult, but by and large it isn't as volatile or as difficult to read as people think. And in most cases the issue it has always been the case that whatever I'm looking at has had a set of data which has been sufficiently useful, or at least where you can do something worthwhile. It may not take you all the way where you want to go to, but there has always been worthwhile data to work with to measure what's going on, to see how it's performing, to identify trends or difficulties or whatever. So my comment would be, yes, there's always dirty data, but in my experience, there's almost always useful data.
One thing a point you made a little earlier, which really interested me, and I hadn't thought of this before. I didn't actually realize you did life insurance before this conversation. Do you think that we lose something as analysts, as practitioners, not having any experience whatsoever with life insurance? At least, most of the people in our company. Me, for sure.
I've never really thought about it. I don't think so. Certainly when I was at university, all of the subjects we did were based on life insurance or pensions. There was no general insurance subject that I can recall doing at university. You did finance and life and whatever. I think it was helpful to have the concept of a valuation basis. That sort of led to the paper, and just simply...
What is a valuation basis? Could you maybe explain?
In life insurance, a valuation basis will be, here are the death rates that I'm using, here are the interest rates that I'm using.
Documentation.
Yeah, it's just a list. It's a list of assumptions, and once you understand how they work, anyone with a calculator can get the same answer that you got.
Right. By multiplying all the numbers together, basically.
That's right.
Right. And so that's a useful concept in at least documenting everything that goes into your final result. Yeah. Very helpful and hard to overlook. Is there anything else to learn from life insurance? I mean, what's something that I would want to know about life insurance that helps me as a P&C analyst?
I'm struggling to think of something. If I look at my decision to move to general insurance, I have an upsetting one here, but basically it grew out of a realisation that life insurance tended to be boring and general insurance tended to be interesting. I think in life insurance, the way I looked at it is you'd come across a problem, you'd realise that was problem number 584, you'd pull out solution 584 and off you'd go. In general insurance, most of the time you weren't even sure what the problem was, let alone how to go and solve it. I did learn that upfront commissions is a bad thing. I think all of the inadequacies and weaknesses and criticisms that could be levelled at life insurance ultimately come down to high upfront commissions.
That's pay more for new business than renewal business.
That's right, and I think to some extent that actuaries are naive. Whilst the mathematics, if you like, the formulae all make sense, I think they're naive about human behaviour in supporting that approach.
Another way of thinking about that maybe is that in life insurance there's no renewal. And so at a renewal, you have to have a negotiation and a demonstration of value from the agent and for the reinsurance broker for that matter. Is that the core difference? You renew business in P&C and so the relationship stays fresh and so everybody keeps talking to each other and appreciating what they're bringing to the table?
Probably put it slightly differently. Many years ago, someone made in essence in insurance, you're dealing with the future, and if you make commitments you need to be able to either have enough capital to cover it or be able to manoeuvre if circumstances change. So in the life insurance field, in those days all the covers were with profits covers, which basically meant they charged 50 to 100% more than what they really needed, and as it emerged that they didn't need that money, they would then issue bonuses, which were just an increase in the sum insured. So that was their control mechanism.
But in life insurance, it would take you a very long time to know whether you've got too much money, wouldn't it?
Yeah, but you do it year by year. You've got a portfolio of risks, and you only release what you recognise at that point. And on the valuation front, a lot of the valuation was, in effect, making sure that the embedded margin still in the future premiums was very, very adequate. So their approach was basically overcharge and gradually over time hand back some of that overcharging. In general insurance, the key trick is you don't commit basically to more than 12 months. If you get it wrong, you renegotiate. And so that's a large part of the mechanism, the control mechanism there. It's clearly not black and white. There are long tail issues in general insurance. There's some contracts that run for more than 1 year. But the fact that you can revisit fairly regularly and renegotiate is a key control factor, and I think a lot of people forget that's why it's there.
So I want to change gears pretty hard here and talk about another part of your career. What happened at GIO?
We'll need a long time to cover that.
It went out of business.
It went out of business. I'll say that it never went broke. It merely decided not to trade forward.
What was your role there?
I was chief underwriter, and I bear some responsibility for that.
And they were a reinsurance company, were they?
GIO was primarily a house and car insurance company. GIO stood for Government Insurance Office. It had been owned by the New South Wales government. At that time it had been privatised. It was listed on the Australian Stock Exchange. I actually approached them thinking that the ideal thing for me to do would be to head up their personal lines division, and for various complex reasons they got me to take over the reinsurance side of it.
That was your first time doing reinsurance full time?
Yes, it was. I'd obviously come across reinsurance in the 15 or 20 years I've been working up to that point of time, but in nowhere near the complexity and detail that I came across at GIO. The key thing there, I would say, is that ultimately reinsurers can usually survive 1 or 2 stresses, but if you get to 3 stresses, you go out. And in essence, that's what happened in GIO's case. There's one particular portfolio that went very, very badly, the aviation portfolio. There was something else that happened, and on top of that, there were 1 or 2 catastrophe events, and those things combined, along with a number of other very political situations, in my view, caused a problem.
And do you think that the company could have survived?
I think it could have, because essentially it has been in runoff and has been in a profitable runoff.
Right.
Part of the issue was that GIO got caught up in a takeover battle in, when would it have been, late 98, I think, which got very personal.
Who's the takeover?
AMP, which was the largest life insurer in Australia at that time, which had a general insurance subsidiary.
Right. So they were trying to buy GIO.
Yes.
And GIO was privately held at the time.
Well, on the stock,
or it was publicly held.
Publicly held.
Okay.
Yeah, they're both publicly held.
Okay.
And they both had US CEOs actually, which was interesting. But yeah, so there was a takeover, the takeover mooted. That took about 6 months to go through the formal processes in Australia, and at that time, the aviation portfolio, the results became apparent, on top of which there were large losses from a number of global cat events. And essentially the new management just didn't have the stomach to sort it out. In my view, they could have.
By doing what? Raising capital, maybe, or what was the in hindsight? What was the strategy? And maybe we can talk a little bit about what it felt like at the time. But in hindsight, what do you think they could have done? I mean, just ran it off, I suppose, since it's gone fine.
Well, that's what they did. They just ran it off, and I think the bottom line was that the new owners. Well, actually, I'll probably go back a step. There were, now getting quite political and personal, I guess, there were steps that could have been taken throughout the middle of 1998 which were not taken. I think if they had been taken, the outcome might have been different. But the real issue was, in my view, for what it's worth, is that there was a huge political infighting going on over both. One of the other factors that was going on here was that in the lead up to that time, the CEO of GIO clearly was going to retire, and there was a lot of destabilisation around who his replacement would be and how that would occur. And I think the board of GIO,
very bad timing,
handled it very, very poorly.
And so, do you think that the company was appropriately capitalized at the time for the risks it was taking?
It's an interesting question. I think its capital was 500 million, which by today's standard is not much. I think at the time that was regarded as quite substantial. In those days, your typical line might have been 1 or 2 million, maximum of 5 million. It was on all the rules in place at that stage. I think it had income.
At the time, you felt like it was too, in your gut.
Yeah,
I think worries about that.
I think it had income. Well, it had income. I'm guessing now in the region of $300 or $400 million of premium income. It had capital of 500 million. It was part of GIO Group, which had much more capital. I'm just talking about GIO Re had 500 million in capital. It did run very big exposures though. It ran $200 million in exposures on property cats.
That was the PML, I guess, or the 1 in 100. I mean, how would you measure it back then?
In those days, it was done as a PML, not a 1 in 200. But in essence, the number was, we do not expect an event to cost more than, I think the figure was 235 million. That was adopted by the board. The board offered more. That number was advised to the regulator, being APRA. What's interesting for me is that there were losses of about $180 million in that 1998 period. And the board professed horror and shock that the losses could be so large, but I know for a fact that's what they signed off, and that's what the regulators were told.
And so it's another important an idea I think of you when I say this, and I say it all the time, is people are a little bit less risk tolerant than they think. Was that a key experience in your life for developing that view?
Yeah, certainly, and I'll try not to use bad language here, but basically, yeah, everyone is risk tolerant when the profits are pouring in, but as soon as the losses turn up, you find out people are nowhere near as risk tolerant as they claim to have been.
And so you, as the underwriter, none of that was your decision. I mean, they're making those decisions and handing you a mandate, fill up this bucket and write this business. Anything you felt you would have done differently in hindsight in running those portfolios?
I now I've got open slather. The aviation portfolio, it basically went from nothing to, I think, $100 million of premium income overnight. That was a decision that I didn't support and was proved right on it. So I think that was a mistake. And I think it had losses or claims of over 200 million fairly quickly after that. And the other issue would be that when it was realised that it had losses of that GIO didn't buy much in the way of retro. The theory was that it was hard enough to write profitable business without paying parts of those profits away, so it had very little in the way of retro.
A common sentiment.
A common sentiment. I'll quote John Palmer here, whose comment is that, retentions are for heroes, but that's going off on a tangent. But one of the basic assumptions behind that was that in a non-cat year, GIO would have had a profit of around $200 million. So the thinking of the director in charge, a guy called Owen Roach, who's now sadly passed away, but who was one of the smartest people I've ever met, and I put him in the same category as Warren Buffett. His view was that in a non-cat year, there was a $200 million profit. If there was one cat, then you'd wipe out that profit. And then it would take two or more cats to move you into negative territory.
Lo and behold, they got three.
Well, no, they got two cats.
Two cats plus the aviation.
Yeah, but that was the issue. The aviation effectively meant that the company moved from, rather than being in the position where it would make a $200 million profit in a non-cat year, it faced the position of making zero or, in fact, making a loss in a non-cat year. And at that point, and I was not involved in these decisions, at that point it would have been, in fact, it would have been necessary to go and actually buy a lot of retro. And at that stage I'd been shifted out, and the new management did not recognise that and did not buy any retro. And in my view, that was a key deciding factor.
How did you calculate the PML or CAT?
In those days, there was the number. It was an interesting question, because when I got there, the board understood that they were exposed to 75 million, and it took me a while to get my mind around it, but within a year or so, I told them it was actually 235 million, and they offered more. We had what we had called the number one account and the number two account. Number two account was basically the retro account, and in the case of the retro account, it was assumed that every dollar of limit was exposed.
Right.
So that was easy, 100% PML. On the number one account, which was a reinsurance account, it would be fair to say there were wet fingers in the air as to the extent to which the total limit could go. Yeah, it was a wet finger in the air.
There must be some sort of precedent you looked at. I mean, it's got to be more than literally just making it up. I mean, you're making estimates of some sort, right? But
there was a process. I'm hard pressed to remember what it was.
What would you do now with the technology of the day? Obviously, no cat models or anything. What do you think would have been a good process for that time?
At the time, I'm sure what we did was a good process. I just honestly can't recall exactly what it was. But in essence, we had exposure. We had all. The thing in those days, and with reinsurance in general, which is quite different to insurance, is each underwriter was well aware of each individual risk that they had written. They were very well aware of the underlying exposures. We coded the exposures. We coded them in great detail. If things were worldwide, that went in there. If they were US-wide, that went in there. But if it was down to a particular state or a particular region, the exposures were coded as accurately as possible, but as broad as the cover was. So we could certainly sit down and say, okay, we have got $700 million of limit exposed in Tokyo or in Japan. And then we could have a view about the PML on that. And we'll just look at, I guess, what the rates were where it was sitting. So it was just sort of, we certainly looked at exposures. And we had PMLs, and we looked at the losses that had happened, I would guess, but beyond that I can't really recall how we did it.
So at that time you were a manager of portfolios, and that's a similar situation to what you walked into, kind of going back in time now, again, to the predecessor to Royal Sun Alliance in Australia there. Now you have an interesting story about some management conferences you went to while you were there, and about the cultural, I mean, what's the right way of putting it? The different messages that were delivered by the underwriting management and by, say, the finance department. Let me tell that story. Okay,
like that story. Okay, this is back in the insurance company days, so before getting to GIO, so we're talking about basically the 80s and early 90s. The company was RSA, as it's now called, but it was sort of a whole series of companies in the lead up to that. Twice a year, you'd have a management conference. There'd be about 30 managers would go to that. There'd be the top one or two people from each region and the top people from all of the various head office departments, etc., etc. It would start at Sunday on a lunchtime. I think the main reason for that was to annoy everybody's wives because you're away for the weekend. And basically most of the time would be senior management beating up on the next tier of management, which included me. And it would just basically be you're not meeting budgets, you're not delivering results, you're not collecting the cash quickly enough, whatever it was basically beating up on the expenses are too high, whatever. Beating up on the management. What I found fascinating was that on the Sunday afternoon there would be some sort of an overview, and that would usually be from finance and maybe from one or two others, but it was interesting in their presentations, never explicitly set out this way, but in their presentations there would always be opening net assets for the firm and closing net assets over a 6-month period or a 12-month period. And I always used to look for that, and annualising the whole thing, the returns would be 13%, 9%, 23%, 8%, 15%, whatever. So over about a 10-year period, the returns were always somewhere between 5 and 20.
Very good.
Net after tax, I might point out, quite adequate returns. The firm was, as far as I could see, delivering everything that its owners could ask for.
So where was the champagne?
Exactly.
And why the difference? Why the difference, do you think?
Partly ignorance, partly, and I think this is actually a comment that John Trowbridge made to me after a conversation he had with Hank Greenberg, who most people would be aware of. Hank visited Australia back in the early 80s, I guess, and he was very big on underwriting profits and ignoring investment income, which I think is a load of rubbish. But his point was that if I take investment income into account, his point was the management is likely to miss the targets. And so if you set realistic targets, the results that will come in will be suboptimal. They'll be below the levels that he needed. If you set unrealistic targets, which they didn't meet, they'll actually deliver okay results. I don't like that approach, but I can sort of respect it.
Mm-hmm. And so when you were in the chair, how did you approach it?
Yeah, it's interesting. What I used to do, this is mainly about investment income.
Okay.
I always took investment income into account, but what I recognised that was to bring investment income into the underwriting statements would basically confuse people. So the way that I did it is that I would set targets which allowed for an investment income. And in those days, what that meant was that a combined ratio of 105 for most classes of business would deliver a very, very adequate return on capital. If you were aiming for 13%, I think, net after tax return on capital, in those days, given capital levels, given investment income rates, given the cash collection and the time frame that you held the funds for, 105 combined ratio met all the requirements. So I would basically set that as a requirement and then say, out of the 105, so much is for commission, so much is for expenses, and so much is for loss ratios. So the underwriters won't have to focus on the loss ratio, which was the only bit they could control, but the target itself allowed for investment income.
And so 105 is one of your three numbers.
Yeah.
What are those three numbers?
Well, the other 65 is one.
Yeah.
I'm struggling with the third one might be. 65.
Conditional claim size severity, average claim size.
Well, he's also 65. There are actually 365s. Very quickly. If you need to come up with a loss ratio pick for a class of business and you're not quite sure what to do, start with 65. Most of the time you'll find that's fairly accurate. And the simple reason is that expenses tend to be in the 30% region, maybe slightly higher. Profit these days, combined ratios tend to be around 95. In that case, you've got to run at 65. So for most classes of business, the loss ratio target, the loss pick, will be in the region of 65. Clearly, there are some classes where it might be 40 because of high expenses or just low competition. Clearly, there are some classes which run at higher figures, either because of unusual financial features or they're just losing money. But if you've got to pick a number out of the air, start with 65. The second 65 basically says that if you are doing excess of loss layers, I'll add another point in here. There's a tendency when looking at excess of loss covers and thinking about how claims happen to think that all claims are total, to implicitly think that all claims are total losses. And whenever we do diagrams for ourselves or charts, whatever it is, we implicitly assume all claims are total losses. That, of course, isn't the case. There's a large number of claims that will be partial losses. In my experience, the average cost of the layer, given that the layer has been hit, tends to be a gain in the region of 65%. So if you have a $10 million layer and I had to make up a number for the average size of a loss to the layer, I'd pick $6.5 million, 65% of the layer. Again, that isn't always the case. If you're dealing with a very low layer that's going to be totaled a lot, it'll be above 65. If you're dealing with a higher layer with a big stretch, it's probably below 65. If you're dealing with aggregate covers, it does tend to be below 50. But for your normal sort of Risk Excel, Cat Excel layer situation, 65 is a starting point. The third 65 is what we at Beach call the Morton Lane factor. Morton Lane is a very intelligent guy involved in the business. He's based in Chicago. He owns a company called Lane Financial, and he's very heavily involved in the ILS market. And if you want to read some well-researched papers and well-thought-out papers, I'd recommend you go to his website and get those. In essence, he did some work looking at expected losses versus market prices, and effectively the conclusion, not that he came to, but that I came to from his work, was that if you had an EL of 10%, say, and you wanted to know the market price, you should take 0.1 and raise it to the power of 0.65, which I'm guessing but probably gives you a rate online somewhere in the 15-16% region, and that would be the market price. And at the time that we did that exercise, again, that seemed very much to be the way things were, that if you had an EL, the market price was that number to the power of 0.65. These days, I'd say it's more like 0.85, but when we first, because basically margins have been squeezed out, they're still very profitable, in my view.
What's interesting about that is, I agree, is true. However, your work on looking at the public accounts for Lloyd's suggests that actually the loss ratios are going down and the profitability is being maintained. So the 65 axiom is being violated, but the expenses are higher and everybody's doing well.
Yeah, Lloyd's is interesting. I mean, one of my pet dislikes, if you like, is misstating what the results are and misleading people. I think it's almost immoral. I think it's to take a management or an underwriting team and in effect to say you're failures or you're mediocre, when in fact that's not the case, I think is, as I say, almost immoral and unethical. If you look at Lloyd's, ignoring 2016, but for 2015 and the prior 4 years, I think the loss ratio was under 50%. It was in the region of 45-48%. That is a phenomenally good loss ratio. Everybody involved in the business should be over the moon with delight at loss ratios at that level. It's unheard of. Lloyd's does have an expense issue, but even so, the combined ratio I think was around the 90% mark, and the loss ratio is phenomenally good, and in my view rates are stable, not declining. The loss ratio for 2016, this is right across the entire market, the loss ratio for 2016 I think is around about 53%, 55%, something like that. That is still in my view a phenomenally good loss ratio, and it pains me to see Lloyd's present that as a poor outcome. That's not what I think the case is.
Is it a coincidence that the loss ratio is low and the expense ratio is high?
To some extent, yeah, I think it is to some extent. My comment there, and I'm not speaking with a broker hat on at this point in time, I always dislike the fact that Lloyd's reported premium income net of brokerage, original brokerage. One of my views is that all of your measures should be to full gross. It should be to what the client has actually paid, and then if you net brokerage off before you put it before you report your income, you have a number there that you just don't watch. You don't look at it, you don't control it, you don't push back. So the original brokerage within the Lloyd's reporting environment, there was no mechanism to highlight the original brokerage level, and therefore was it easier for the powerful brokers to increase brokerage, and good luck to them, they're able to do that. I think so. To me, the underwriters failed to push back because they had poor reporting. To be fair, I think the other issue there is that Lloyd's has, to a large extent rightly, but I think a little bit excessively, increased the costs of trading at Lloyd's. Compliance costs are much higher than they were in the past, and I think Lloyd's has an issue with costs in total that it needs to address.
So it's clear, of course, that you're a student of financial analysis, and quite literally, and that you are an accountant. And so maybe talk about that transition in your career, which happened just before you started working with us at Beach, where you decided to become an accountant late in life. And why'd you do that?
Okay, I'll start with, I think my favourite actuary joke is an actuary is someone who wanted to be an accountant but didn't have the personality. My departure from GIO was not of my volition, so I became a consultant, which is another word for being unemployed. And at the time, given the fact that GIO Re was blowing up, it was uncertain whether I would in fact be able to get any employment in the insurance industry. So I needed a fallback position, and that was accounting. That was, for me, a relatively easy thing to do. So the reason for getting the accounting qualification was really to have a fallback position if I was unable to get consulting work on the actuarial side in the insurance arena. As it turned out, that was never a problem, but having got the accounting qualifications, I find it useful to understand some subtle differences between how actuaries and accountants look at results, and I find it very valuable to be able to go through financial accounts and sort of see through to everything that's going on in the firm. And it is occasionally valuable to be able to speak to the CFO and in effect say, well, I'm an accountant, not an actuary, for these particular purposes.
So what is the difference between how an actuary and an accountant look at the financial results?
Well, I'll talk about specifics there, and I'll talk about unearned actually. In an actuary's mind, the unearned premium liability is a liability in respect of future claims. It's an estimate of future liabilities, and actuaries approach it that way. That's what they see. They see a liability for future claims. Accountants don't see it that way. Accountants see it as a deferred income item. They basically say you have collected money from people, from insureds, but you haven't delivered the service. The service that you have promised to deliver is happening in the next or subsequent accounting periods. So they defer income. So actuaries value a liability, accountants defer income. And then they do a test to see whether they've deferred enough, if you like. But there is a subtle difference there, and I think there can be a lot of confusion at times between actuaries and accountants over that very fundamentally different starting position.
And so how does that different starting position manifest itself in the reinsurance buying decision? Because they have different perspectives on reinsurance as well, CFOs and chief actuaries.
Yeah. One of the key dilemmas I'm still struggling with is how do you, if you like, define, measure and explain the value of a reinsurance transaction. If I go back a bit and just look at insurance from the man in the street's point of view, insurance is typically a very expensive purchase, and what do you get? A piece of paper. It's hard for the man in the street to see value. It's a resented purchase. You might need to buy it because the bank has said you've got to insure your house, or you've got to insure your life, or you can't drive a car unless the car's insured, or you've been told you have to have insurance for the business that you're running. It's a resented purchase that most people cannot value. What daggers me, I guess, what surprises me is that a lot of reinsurance buyers have the same attitude, and I find that quite surprising. So I think there's a lot of work to do to define the value of reinsurance. You can say all the obvious things. It's to do with volatility, it's to do with 1 in 200, to do whatever. I think there's a tendency, particularly on the part of actuaries, to overly focus on the 1 in 200 number, which is the capital standard, and to under focus on what I'll call the 75th percentile, the 1 in 4. I think if management was honest, they would say their concern is mainly with earnings protection, and making sure that they don't underperform relative to the market. So I think there's a huge disconnect between reinsurance spend, expected recoveries, and, if you like, recoveries in remote but plausible scenarios. I think there's a very, very poor balancing of those items in most management's minds.
Is that just because it's hard?
It's hard. It's in theory, you I think what you have to do, my thinking along these lines is, we tend to, when we do optimization work, is to look at the full range of outcomes from the 0th percentile to the 100th percentile. And you effectively have to say, how do I value the potential profit or loss at different points in that distribution? If you value them all equally, which is what an expected loss does, then you should probably buy no reinsurance whatsoever. And I think the trick to it is to say, well, obviously the more extreme outcomes have a higher utility cost, if you like. And so that therefore, in the back of my mind, we need to get some measures that actually say $1 of loss at the 40th percentile is far less painful than $1 of loss at the 98th percentile.
But, it just got GIOs bored, that question. And, the problem, I suppose, is self-deception. You don't realize that and to actually have the magnitude of that difference necessarily until it's too late.
Yeah, that's another way of me saying everyone's risk tolerant until they suddenly have huge losses to contend with, and then you suddenly find they're much more risk averse than they thought they were.
Mm. And so that's why reinsurance is hard. And we're running out of time here, so maybe you can close by just talking a little bit about what you like about reinsurance. Why are you still doing this, Rob?
Well, I like it. It's challenging, it's interesting, it's constantly changing. I'll be polite, it's a marvellous mix of science and art. There's no right answer. It's constantly evolving. There are basics that I think are timeless, and there's innovation that takes place constantly. We've recently done some deals on some very standard sort of quota share contracts. I can't go into details, but there are very simple things you can do that have very subtle differences. And those subtle differences are about the cost, they're about the capital involvement. The thing I like is just it's constantly evolving, it's constantly moving, it's very challenging, it's financial. I do like the fact it's one of the last unregulated areas. We're dealing with allegedly sophisticated buyers and sellers. They're capable of looking after themselves. So that means we can be quite innovative. The travel is good. I'm just a boy from the western suburbs of Sydney, which is where all the bogans are, call it lower middle class. I've been to Bermuda, I've been to Zurich, I've been to New York and London, I've been to Chicago and Singapore and Monte Carlo, Berlin, Munich, and amongst obviously a whole host of places, Toronto.
Has it changed? Has the business changed? I mean, so you did your first reinsurance transaction probably when you were at QBE, I would think, in some way. And any insight there in thinking back to that experience and how it might be different or the same now? You were a buyer then, it would have been, or
very junior.
Yeah.
I think the answer is sort of yes and no. A lot's the same, a lot's different. I think in those days, it wasn't as sophisticated. A lot of it was based on relationships. A lot of it was I see reinsurance as a sort of shock absorber over time. And I think in those days, clients and reinsurers were prepared to enter into a longer term relationship, and that therefore over time things would even out and whatever. I think these days buyers are compelled to take a much shorter term view, and therefore reinsurers also have to take very much a shorter term view. In those days, everyone talked about payback. Payback doesn't exist.
But the relationships are still strong, and that's what the travel's all about. I mean, that's why we do it, right?
Yeah, relationships are very important. At the end of the day, reinsurers are underwriting the management and underwriters of the insurer. You can do all the statistical analysis you like. If they're, not competent or fraudulent or just not running a good business, then they're not going to be a good reinsurance risk. Ultimately, you're forming an opinion about the ethics and competence of the management and underwriters that you're reinsuring.
My guest today has been Rob Johnson. Rob, thanks for joining.
Thanks, Dave. Been a pleasure.